All right, then. Good evening again, everybody. Today we are going to begin chapter 6, which deals with, as you can see on your display, interest rates and bond valuation. So we will continue with our agreed upon format. Some parts of the chapter, selected parts, I will discuss with you. Most of the parts will actually deal with some preliminary conceptual understanding, and then we will go straight into numerical demonstrations, which means obviously that some part of the chapter, which is purely reading material, we do not usually cover that in a live session. And I believe that when you do your self-study, you will read up the whole chapter, right? So I will indicate to you during the discussion also which part I'm skipping, because that is particularly just a reading material and you should follow your textbook for that. But I will get you started with the concepts first, and then we'll pick up some exercises in bond valuation and computing the yield to maturity. In the process, we will also use the financial calculator. But let me just ask, would you want to solve numerical problems tonight with the help of only the calculator, financial calculator, or would you still want to do the manual process as well? What is the general agreement on that?
Using the calculator alone is fine with me.
Okay, Majiv. Anyone else has an opinion on that? Should we skip the manual process altogether, or should we continue to use that too?
Well, my situation, I still didn't get any financial calculators yet.
John, what are you doing? Get a calculator.
All right.
If you can't, I mean, get an app on your phone. It just works just as fine. Okay, so let's begin. First of all, as the title of the chapter itself suggests, it's broken down into two parts. One deals with the interest rates, that's the initial part of the chapter, and then we will go to bond valuation, right? So I've picked up some basic fundamental questions that anybody reading about interest rates would need to know. And if you don't know, maybe you need to ask such questions and ensure that you have some kind of a starting understanding about these things. So obviously, if we start to talk about interest rates, then the first question that would come to our mind is, what is an interest rate? And that is something simple. Everybody deals with this term on almost a daily basis. If not daily, I mean very, very frequently. So it's simply, if you think about it, you can break it down into two parts, basically. What did I do? Okay, two parts here. One part is from the point of view of a lender of money, and the other point of view is from the point of view of the borrower of money. So for the lender, it is simply a compensation for lending the money. You can say compensation or you can say reward. Otherwise, why would you lend your money unless you're getting something out of it, reward or compensation for your lending? And the same thing from the stance of a lender, if it becomes your compensation, the same thing from the stance of a borrower would become, from their point of view, the cost of borrowing, right? So cost of borrowing depends on which side you are on. If you think a little bit more about interest rate, a related question can come to your mind. What is it that may have an impact on interest rate? So if we change color, we can just make a mention of few usual culprits there. When I say that, I mean what can be the various factors which can have an impact on interest rates? Well, one obvious culprit is the inflation. So if inflation increases, the interest rate would also increase with it usually, because after all, what is interest rate? If you perceive money as a product, if money is the product, money is product or a commodity maybe that can be purchased and sold, then the price of money, price of money is the interest rate. So if inflation is rising in an economy, then the prices of all products and commodities and goods and services in general are increasing. So why would money be an exception? So understood that way, since money is also a part of a basket of goods and services, then the price of that product will also increase and be reflected in a higher interest rate. Then the interest rate which the lenders will charge usually from borrowers. So suppose you go to take out a loan and your lender would quote an interest rate. It would depend on not only the inflation, but they will also look at your face. They will also look at your profile. They will also look at your background. Where do you work? Are you working on a contractual basis? Do you have a 10-year job? How many years you have left till retirement? What are your assets? Do you own a house? Do you rent a house? What's your family profile like? What's your health condition like? Do you have any existing loans? Do you have a credit card? What is your credit history? If you had borrowed before, were you able to repay the loan successfully, and so on and so forth? Hundreds of questions will be there in their mind. And depending on how risky a person they perceive you to be, they will decide on an interest rate to charge from you. Because if they perceive you as a highly risky candidate, maybe if they don't refuse your loan application right away, then at least they will want to charge you a higher interest rate, because what do they want for their lending? They want compensation. And if that lending is risky business, then they would want that compensation also to account for that risk. They would want to be compensated for the risk as well. So risk is another factor which can affect the interest rates. Then another reason, another factor that we can think about is called liquidity preference. Liquidity preference. Everyone here, I believe, understands the meaning of the term liquidity, right? So for example, cash is the most liquid of all assets that we know, and people want to hold such assets with them which are as liquid as possible, so that if a need arises for them to liquidate those assets or sell those assets off, then they should be able to do that with convenience, with ease, and with a certain degree of speed, right? So they shouldn't have to wait long, and the process should not be difficult to sell off their asset and thereby convert it into cash. So there's always a preference for liquidity. So whenever there's a preference for liquidity and you have a choice, like for example, if am if I'm entering the shoes of a lender, then if I have a choice whether to lend out on a short-term basis or to lend out on a long-term basis, where would I feel more comfortable? Where will I feel my lending is more liquid, right? I will feel that the short term is more liquid, it's more certain, because long term is just over the horizon. It's not very clear what's going to happen in the long term. N number of things can happen. Something which is liquid today may not be that liquid tomorrow. Maybe, who knows what's happened? Rules and regulations may change, inflation may change, the risk profile of the person who borrowed from us may also change. In the long term, well, the borrower may fall ill, the borrower may get injured or something. It may compromise their ability to earn, and therefore compromise the ability to return the money to you. Or God forbid, if they were to leave the world, if they were to die, then your loan would be in jeopardy. And if that is in jeopardy, then your liquidity is compromised. How do you recover your money? Unless you can recover your money, the liquidity part of that loan is in question then. So the general preference would be to gravitate towards more short-term loans. Investors or loan givers usually have a tendency to prefer short-term loans, right? To give off short-term loans. One thing we need to understand here at the outset that whenever I'm saying loans or lenders, remember, whenever it is that you decide to give a loan to somebody, or when you decide to lend out your money to somebody, you are actually investing your money. Spare a thought for this. It is an investing activity. Because in giving out a loan to somebody, you create an asset for yourself. Why an asset? because this asset in the form of the loan is going to ensure interest income for you. You are going to continue to receive the reward or return or compensation in the form of interest income for as long as the loan is alive, right? And at the end of the period, you will also recover your principal amount. So we consider anybody who's lending out money is actually investing their money. So lenders are the same people. For the purpose of this chapter, we will consider them as investors as well. So, for example, if you buy a bond, what happens? When you buy a bond, it's basically an agreement between you and the company where you have decided to lend your money to the company for some time. And in return, the company will keep on paying you interest. So in doing so, the same bond which has been sold to you by the company becomes their liability, because selling the bond would mean that they have borrowed money from you. Selling the bond or issuing the bond is the same thing, and it simply means that the issuing party or the selling party has simply decided to take a loan or borrow money. And because they have borrowed money from you, from company's point of view, that bond becomes their liability because they have to continuously make interest payments on that bond. But from your point of view, it becomes your asset, because in lending the money to the company, you have performed an investing activity and have created an asset for yourself, which is going to bring you interest income for as long as the bond lives. So let's have that clarity as we proceed ahead. Right. The next item that I see on the list, which I had jotted down while I was just looking at your chapter from the textbook, is they were talking about different type of interest rates. The nominal interest rate was one of them. But before we can begin to talk about this nominal guy, we should first of all understand what is the real interest rate. Real interest rate. Real interest rate. In your chapter, the authors of your textbook have chosen to denote this real interest rate. They write an R and they write an asterisk in the superscript. R star is the real interest rate. Real interest rate, folks, if you try to understand that in as simple a way as possible, it is simply that it is the interest rate which will prevail in an ideal world. Ideal world. And if you want to use the language of economics, then it will be an interest rate which will prevail in a world which is perfect. So the question becomes, what is a perfect world or ideal world? The perfect or ideal world is where there are no market imperfections. There are no distortions of any sort, market imperfections. Right? What can be examples of market imperfections? So, for example, there are no taxes. There is no inflation. Right? Where no one has any liquidity preference. So long term is just as equally desirable as short term. So there's no liquidity preference. Because the world is fair and square, there is no raw deal there for anybody, right? So whatever and whoever is deserving of whatever interest rate, they will get that. Nothing will interfere with that. No taxes will interfere. No inflationary forces will interfere. No liquidity preference will interfere. And there will be no type of risk as well. You can feel assured, you can feel certain that you are not going to be shortchanged. If you deserve something, you will get it. If we could live in that type of the world, then if you ask a question in such a world, what would be the interest rate for a given activity? And that interest rate, if you would refer to that interest rate, that would be the real interest rate, right? So if the real interest rate is, let's say, X%, and then you start to bring in one by one the market imperfections, then you say, okay, because there are taxes, okay, even if you give me 6%, I'm not able to carry 6% home because 25% of 6% is taken away by the tax man. but I'm insisting that I need to carry 6% as my take-home income. So which will mean that they will ask you for a compensation. So something, a percent will be added to compensate for this tax part that has come in. So now you have deviated from the real interest rate. So the actual rate has become X plus A%. So now then the other guy says, because inflation is eating away at the value of the money. So therefore I need a compensation for that also. I need a premium for inflation too. And which is, in my view, it's B%. So you have deviated further from the real interest rate. Now it's X plus A plus B%. Like that, the more the imperfections, the more people, when I say people, I mean the people who are lending the money will demand a compensation for all these market imperfections, and we will keep moving away and away and away from the real interest rate. And we will keep moving away from the perfect world that we had imagined for ourselves, and the interest rate will have to then reflect all these distortions that have been brought about from the marketplace. Folks, any questions up until now? Am I making sense? Everyone all right? Okay, so no response means they say no news is good news. So that's how I'm going to interpret that and move further. Let's just add a page. So we just talked about the real interest rate, and we saw how when the market imperfections come in, we deviate or move away from the real interest rate. The real interest rate in your textbook is denoted as R star. So if we are moving away from the real interest rate, we begin to actually start thinking about the actual interest rate, And this actual interest rate is what we call the nominal interest rate, because that was the question at the top, which we had noted here. If you recall, question number 2, what is the nominal interest rate? And now we can, after having looked at briefly at the real interest rate, we can now talk about the nominal interest rate, where we can say that nominal interest rate is nothing but the actual interest charged by the supplier of funds and paid by the demander of funds. So supplier of funds. So I'm just using alternative terminology so that if you come across this, you don't feel that this is something alien. Supplier of funds and demander of funds. So supplier of funds is basically, if you act as a supplier, basically you are the lender. And well, when you're lending, you're actually investing your money. And demanders are usually then borrowers. For them, the interest rate is a cost. For suppliers, because they're investing, it's return or reward. So it depends on which side of the table you are on. So the nominal interest rate is the actual interest rate, which is charged by the supplier and paid for by the demander. So once we know, let's just change to blue and write this real interest rate here again. Once we include the following distortions with the real interest rate. One, if I add interest, if I add, let's say, inflation premium, because I demand some compensation for the fact that the money keeps losing value over time. So I add that to the real interest rate, and before I quote it to the demander. So this guy is asking how much interest rate he will charge me. So I'll say this is the minimum, and then plus I need some compensation for the inflation as well. So I will call that inflation premium. And plus, you're okay. I mean, you work in a reasonable job, but you're not really keeping good health, and you have a couple of loans running at this time as well. So your credit rating is not particularly very encouraging. So this is kind of a risk. Maybe at some point in time, you may find it difficult to repay my loan on time. So if I'm going to lend my money to you, I'll be taking on this risk and I will need a compensation for that. So I'll just say I will need a little, let's say a little 1.5% extra for that risk premium. Right. So we have moved away from the real interest rate and we have allowed for these two distortions to be added. And this becomes our nominal interest rate. So in your textbook, your authors have chosen to write it like this, R1. So R1, this is the nominal rate then. So anytime we enter into a contract with somebody or we sign a loan agreement or something, we invest our money and the rate of return which has been promised that we will receive that rate of interest, or if we take a loan and we agree that we will pay that particular rate of interest for the loan, that rate which is mentioned or stated in the contract is always the nominal rate. We don't really see the real rate, but there is a component there which is real rate, usually unseen. What we deal with in our day-to-day workings is the nominal rate. So please do remember, nominal rate is equal to the real rate, R star, plus the inflation premium, plus the risk premium. Another thing that you can do here is, you can, if you combine these two guys here, these two, which is the real interest rate plus the inflation premium, you can use just one term for them, and that is the risk-free rate. Often denoted as R, and in the subscript we write F, right? So another way then of writing the nominal rate could be R1 is equal to the risk-free rate of interest plus the risk premium. Right, your authors in the textbook, they choose to write the risk premium as RP1. Ladies and gentlemen, any questions up until now? Because if not, then we will move to a demonstration problem related to this. Can we do that? Or do you have a question that you need to ask first?
No questions, sir.
Okay, all right. So let's move to this problem. I've just copied and pasted the problem from your textbook. It's asking us, it's a question about risk-free rate and risk premiums. It says the real rate of interest is currently 3%. So when they say that this is the real rate of interest, actually this 3% then is the R star. The inflation expectation and the risk premiums for a number of securities follow. So this is the inflation premium, and this is the risk premium, right? So the question is easy enough. Part A asks us to find the risk-free rate of interest, RF, that is applicable to each security. It's a fairly straightforward thing to do. So if I just open up a column here and call it risk-free rate of interest, you will remember from before that risk-free rate of interest is simply a sum total of the real rate of interest plus the inflation premium. So this 3% here at the top is the real rate of interest. And this column is giving us the inflation premiums. We just need to add the two together. So for the first security, it's 3 plus 6, 9. For security B, it's 3 plus 9, 12%. For security C, it is 3 plus 8, 11%. For security D, it's 5 plus 3, 8%. And 11 plus 3, 14 is the last one. So pretty straightforward there. Then in part B, they say, although not noted, what factor must be causing the differing risk-free rates found in part A? So what we have observed is that for these securities, these financial instruments, A through E, all of them have a different risk-free rate, in spite of the fact that the real rate of interest is 3%. So then what must be changing? The inflation premium demanded is changing because these are variable. These are not constant, as you can see, 6, 9, 8, 5, 11. So what most likely the scenario is that these securities here have different maturity dates. So maybe this is maturing in 6 months from now, and we expect that in 6 months the prices may go up by 6%. This may be a 1 year security, and we say by the time 1 year is done, the inflation may have gone up to 9%. This is the third security, which might be maturing in 2 years from now. And we are expecting that maybe the government will get some handle on the inflationary forces. And by the time 2 years are done, the inflation might have fallen from 9 to 8%, like that. So different maturities are implied, actually. So part B simply tells us that because there are different inflation premiums involved, this hints or indicates towards different maturity lengths of these securities, right? Some securities maturing in 6 months, another maturing in 2 years, maybe some other maturing in 4 years, like that. Then part C is about finding the nominal interest rate for each security, nominal interest rate. So if we were to open another column here, your authors chose to write the nominal rate of interest as R1. So what is R1 equal to? Nominal rate is actually the real rate. Let's rewrite it here. R1 is equal to your real rate, which is, well, 3%, plus what do we need? We need the inflation premium, which is available in the second column, and we also need the risk premium, right? Or you could have simply used a combination of these two, because a combination of these two you have already calculated in this column. So this column plus the risk premium, I should have written RP here, the risk premium, that would give us the nominal rate of interest. So what it would be for the first security, security A. So since the risk-free rate is 9%, which is made up of this 6 and this 3 here at the top, 6 plus 3, 9, plus the risk premium of 3% will give us 12% here. Likewise, we have risk-free rate of 12% here, plus the risk premium, that gives us 14%, and like that. This is 11 plus 2, 13%. This is 8 plus 4, 12%. This is 14 plus 1, 15%. So like that, pretty straightforward. Right, good, everyone. Can we proceed ahead? All right, it seems like everyone is okay. Let's go ahead and talk about something else related to interest rate. And this is something usually as a student of finance, you should have a working understanding of what is meant by the term structure of interest rates. So ladies and gents, whenever you come across this terminology, term structure of interest rate, right away you should know that the meaning of this word term is time to maturity. Remember, we are talking about interest rates. So interest rates are applicable only when there is some kind of a lending and borrowing arrangement. And any financial instrument which is based or which is constructed on the basis of this lending and borrowing arrangement is a debt security, not an equity security. Because if we started thinking about equity securities, which is the concern of our next chapter, if we started thinking in terms of equity securities, then there will be no talk about interest rates, really. We will be talking more about dividends at that time. The moment we think in terms of interest rates, we are thinking that somebody is lending their money, somebody is borrowing the money, and therefore there's some kind of a loan arrangement, or there's somebody is offering debt and somebody is taking debt. And if any security or financial instrument, like a bond, for example, is constructed on the basis of this lending and borrowing arrangement, then these securities will carry interest rates. And usually these securities will have a certain specified date of maturity. Shares which are a part of equity, you realize they don't mature really. You buy a share and it goes on and on and on. Its lifetime is unlimited, unless, of course, the company was wound up or liquidated. But bonds and other debt instruments, they have a defined maturity date. So, and that is what is known as the term of those financial instruments. So basically, when we are trying to study the term structure of interest rate, we are actually trying to define the relationship between the time each of those securities have before they mature, and how does this time play its role in impacting the rate of return, how the rate of return is impacted by the time, right? That's what is the term structure of interest rate. So it's good that we have mentioned this term here, rate of return, because if you know what rate, if you understand intuitively what rate of return is, then formally it won't or it shouldn't be a problem for you to understand that this rate of return would be referred to as the yield to maturity, which simply means yield means return to maturity simply means that if I purchase a debt related financial instrument today, purchasing means what, folks? Please be mindful. Purchasing a debt security means what? Or first of all, selling a debt related security means what? You are selling a security because you need money. So you need money, so you need to borrow money. So you need to borrow money. So you say, okay, I'm going to sell or issue a security. So will issue, borrowers will sell because they need money and they need to borrow the money for whatever use. So they will be able to sell only if they have a counterparty, right? You cannot sell something unless you have a corresponding purchaser. So anybody who's wanting to purchase, purchasing will mean that you are willing to lend money. That means you have a temporary surplus of that money and which you can lend. And basically then you're looking for a reward for your lending, which you can understand as return, which you can understand as the yield. So if I'm purchasing a security today, and let's say it matures at this particular time, if I and this is the maturity date, let's call it well, let's write it as M for maturity. This is where it matures. Then if I hold the security for the full length of time till the time it matures, then during this whole time, what would have been my return yield till this point in time, maturity? That's what yield to maturity basically is. Let me return briefly to number 4 here, term structure of interest rates. We were talking about the fact that when we discuss term structure of interest rate, we are actually wanting to establish a relationship between time that a particular debt-related security will take to mature, and that time, what's its impact on the rate of return of that security. So that understanding can be expressed in the form of a yield curve. If you want to have a graphical quick snapshot, then you can just plot a yield curve. So if you ask me what's a yield curve, it is simply a time plot of yields. Time plot of yields. So for example, on the horizontal axis, I have time. On the y-axis here, I have the yield or the return, call it whatever you like. Here is time period 1, time period 2, 3, 4, 5. So if you invest in a financial instrument, obviously debt-related financial instrument, which will mature in 1 year or 1 period from now, and you can get this much return for it. And if you invest your money in a 2-year instrument, which will mature, which you purchase now at time 0, and it will mature in 2 periods from now, and if you can fetch this much return for that, like that, if you can fetch for a 3-year instrument this much return, or a 4-year instrument this much return, like that. So if you connect the dots, this becomes a yield curve. It quickly tells you that depending on your intention of investing your money for whatever period of time, the length of time, you will get a certain rate of return. So you can see the relationship between the time and the yield through one simple simple line like this, the yield curve, right? So this basically tells us about the term structure of interest rates, how time is affecting the yield. Talking about yield curves, folks, there can be different types of yield curves. We can normally distinguish between three types of yield curves. Number one is a normal yield curve. Normal yield curve. Normal yield curve is usually like the one we plotted here, usually upward sloping. If it is not upward sloping, then there can be two other possibilities. Either it can be downward sloping, in which case we call it an inverted yield curve. Not a good one to have, because who would like a curve like this? What does it tell you? That if you invest just for 1 year, maybe you will get 15% return. But if you invest your money for a long period of time, say 5 years, you will just get 3% return. So why in the world would I want to invest for 5 years just to get 3%? I mean, it just simply tells me that the economic activity in the times to come, in the future, the economic activity might be really going through a slump, and everything must be going southwards. And there must not be enough productive or economic activity going on. And so therefore, in general, the price levels of everything are falling. So, we generally complain about prices rising and there's inflation, and this also, the inflation also tells us that there is enough consumer demand in a particular economy, because unless and until people will demand products, they will skip the marketplace. Isn't that so? Nobody wanting to participate in the market and wanting to buy something, what will happen to the prices of those products? They will start falling, because the inventories of products will start building up, because there is no buyer interest. So since the inventories are building up, then the factories and the manufacturers, they just don't want to produce something new, because the old stuff that they had produced is not selling, right? So that's lying there in the warehouse getting rotten. So what's the point in producing something new? And if they don't want to produce something new, why in the world to retain the workforce? I mean, send them home, right? So on the one hand, prices are falling. On the other hand, people are losing jobs, unemployment is rising, production activity is slowing down. These are not good signs. And if prices are falling, and we understood earlier that interest rates are nothing but price of money, so which means a downward sloping yield curve, which tells me that 5 years from now, the interest rates are likely to fall to this level, is kind of a worrying sign for me. It tells me that the coming times are not so good, actually. So inverted yield curve, red flag. And the third possibility is that it's neither upward sloping nor downward sloping. It just dead flat yield curve, right? This tells you that you need to be cautious. Something unpleasant might happen, right? It's not bad as yet because it's not inverted, but unless of instead of upward sloping, the fact that it has become flat now tells us that an inversion might not be that far away. So the time to take action is when you see a flat type of a yield curve. Right. So this relationship between the time and the yield is, the economists have tried to explain it through three theories, and we'll look at them briefly, one by one. Here we have them here. I've listed them out for you. These three, the set here. The pure expectations theory, the market segmentation theory, and the liquidity premium theory. Let's talk about the first one first, pure expectations theory, and let's try and understand that with the help of an example. This is an example. So let's just do the example first, and then we can do some observations. And through those observations, we would have understood what pure expectations mean. Everyone knows the meaning of the word expectations. Investors have an expectation. Well, in general, the whole market might be feeling that interest rates in the future may go up, or they may have a common general understanding or expectation that the interest rates in the coming time periods may go down. Depending on what the general expectation about interest rate is, we can project the trajectory of the yield curve. So if most of the market participants are thinking that the interest rates might go up, then we will have an upward sloping yield curve. We can project that at least. And if an opposite view is being held that there's a likelihood that in the future the interest rates may drop, and it's a view which is shared widely by the market participants, then we can expect or project that the trajectory of the yield curve may be downward sloping, and there may be something, there must be some unpleasant times, economically speaking, that we may have to face. To understand the pure expectations theory, I've constructed a very simple example here. First of all, within the construct of this example, we will define long term as 2 years. Though by any stretch of imagination, 2 years is not long enough to be called long term. And short term, we will call it 1 year. So with this kind of a framework, let's see two investment strategy here. There is some investor who wants to invest their money for a period of 2 years. Investment horizon is 2 years. Ladies and gentlemen, I would just like to make a quick concept check here. Please do participate, open your mics or use the chat box. Don't remain silent. Somebody's investment horizon and who will follow some kind of an investment strategy tells you what kind of a stance this person is assuming, that of a borrower or that of a lender. Because it says here, invest in a 1 year instrument. So when you're investing in a debt-related financial instrument, so then which stance are you assuming, borrowing or lending?
Borrowing, I believe it's borrowing.
No, lending. Samantha is right there. Lending, because when you lend money, only then you will receive the interest. So this lender, who may be having some surplus money to lend out, is thinking of the following investment strategies. The first one is invest in a 1 year instrument, so 1 year investment at a rate of 10%. So since this decision is going to be taken right now, and the investment is going to mature after 1 year, we know right now, we know that this rate is 10%. We are certain about it. Then when this investment matures after 1 year, then invest in another 1 year instrument, because our investment horizon is actually 2 years. So the first investment will be done in 1 year's time, and then we will still have 1 more year remaining. So next year, then invest in another 1 year instrument, right, after 1 year. But at that time, what will be the interest rate? We can't say with certainty, but we can have an expectation about it. So that's why expected rate. We expect that after 1 year, when we will want to invest for another year at that time we will get an 11% interest rate. So the expectation is that the interest rates will rise in the coming times. And the opposite could have happened as well. It's just an example. The expectation could have been that next year, when we are ready to make another 1 year investment, the rate instead of 11%, maybe 8% or 9%. So that is an equally valid expectation too, right? So this is one of the ways to cover your 2 years investment. The second strategy is invest straight away in a financial instrument which will mature after 2 years. So no stopping in between. In the first strategy, you invest here at time 0, and your first investment matures here at time 1. Here you make then another investment which matures at time 2. So you have this period of time and you have this period of time, and there's a break in between here. In this strategy, you invest at time 0, no stop. It matures at time 2 straight away, right? The question that you see below is, what is the expectation about interest rates? Well, we have answered that. The expectation is that the interest rates, I'm just writing I for interest rate, or your textbook, I think, uses the letter R. So let's just say R will rise. So the next question here is, what rate should the 2-year instrument offer to compete with strategy 1? What do you think? What do you think? If you were following strategy 1, this one, let's just change color to blue. If this is the strategy that you were following, then what happens if you do a timeline? And to do this timeline, just to keep it simple, we will just ignore time value of money. We will say we are investing here at time 0 for the next 1 year, right? We will earn 10%. And when this one matures, at this point in time, when we are ready to invest again for the next 1 year, this period, then we are expecting that we will earn 11%. So in all, over the 2-year period, we would have earned 10 plus 11, 21%. Isn't that so? Right? So can we say that over this 2-year period, then on an average, what's my average return? 10 plus 11 over 2. This 21 over 2 will give me 10.5% per year. Is everyone following this? So on an average, 10.5% per year we have earned with this strategy. But if there is now an instrument which somebody says, no, don't follow this strategy. Instead, invest here at time 0, and this investment starts here and goes straight till time 2. How much per year rate it must offer, so that this is not inferior, so that this is also at par with the first strategy? What do you say? In the first strategy, the per year rate on an average that you got was 10.5%, broken into 2 components, 10% for the first half, 11% for the second half. But if there are no first halves and second halves, there's just one whole consolidated time period of 2 years, then what should be the per year rate? What should this instrument quote? That we are offering you an interest rate of what % per year or per annum, so that this is in no way inferior than the previous strategy. Do you have a response, anybody? It is just, yes, John.
Well, it will be same thing like that, 10.5, right? Correct?
10.5, yes. This 2-year instrument here, this 2-year instrument here, this one, this must offer at least 10.5% to be at par with the first strategy. Otherwise, what will happen? Otherwise, the 2-year instrument will not be able to compete. It will be simply forgotten by the investors. Nobody will buy long-term. See, we defined in this context long-term as 2 years. But long-term could be anything, 10 years, 20 years, 30 years. So what is happening here? If you observe carefully what we did here with the first strategy, we took the first 1 year interest, we took the second 1 year interest, and we calculated a simple average, which was 10.5% a year. If the long-term instrument cannot offer a rate which is equal to an average of the short-term instruments, then people will forget about the long-term instruments. Nobody will be willing to borrow. Nobody will be willing to lend on a long-term basis at all. So basically, the lesson that comes forth through this is that the pure expectations theory says, well, here the expectation is that the interest rate will rise from 10 to 11%, 10 to 11%. So it could have been a falling expectation too, 10 to 9%. That is equally valid. What we have just confirmed is that the long-term rate, this one, is equal to an average of the short-term rates. So that if we were preparing a column like this, years, and then we were writing the yield in front of it. So for investing in an instrument which matures in 1 year, you get 10%. If you want to invest in an instrument which will mature in 2 years, you would get 10.5%, folks, right? And so if you plot a yield curve, 1 year is 10%, 2 years is, well, a little more than that. If you connect, it will be an upward sloping yield curve. Why is this upward sloping yield curve happening? Because we were expecting that 1 year later, the interest rate would be a little higher from what it was in the preceding year. The expectation was that the interest rates in the future will increase, and that is being reflected in this yield curve here. It's upward sloping. If we had used 9% instead of 11%, we would have gotten a downward sloping yield curve. So this theory then basically states this, that number one, long-term interest rates are nothing but an average of short-term interest rates. It also says that the yield curve, when we plot it, it reflects the expectations of the investors about the future interest rates, right? Where expectations of rising interest rates in the future will create an upward sloping curve, and of course, vice versa. We have also seen that a series of short-term financial instruments, like in this case, we had in first strategy, we had a series of short-term instruments. This was the first one in the series. This was the second one in the series. So the return provided by a series of short-term instruments is the same as that as that of the long-term instrument, which is this. Because if you take an average of these two, 10.5, this must be the average. This must be the return here as well, so that both are at par. Because at the end of the day, both of them are 2-year investments only. So if the product is the same, what is the product? What is the item that is under the microscope? The product is a 2-year investment. How can the same product have two different prices? It shouldn't. So if the product is the same, well, if my potatoes cost me, well, what, $5 a pound or $10 a pound, whatever, then in Tuna Puna market, then they should cost me the same thing in the Makoya farmers market too. Otherwise, what will happen? Otherwise, people will gravitate towards wherever it's available for a cheaper price, which will force the other market also to reduce the price. So the price parity will obtain again. Ladies and gentlemen, if you have understood pure expectations theory, I will make a statement. You tell me, please, whether I'm right or wrong. Listen carefully. I'm saying that if pure expectation theory works, then bonds or debt-related financial instruments with different maturities are perfect substitutes of each other. Did you hear me well? I said financial instruments having different maturities will be perfect substitutes of each other. I hope you know what are perfect substitutes. So if I were to come to your place and you were to ask me, Dr. B, would you like to have a cup of tea or a cup of coffee? And I told you either one is okay. I'll get the same satisfaction from a cup of coffee or a cup of tea. Then for me, in my mind, a cup of tea is a perfect substitute for a cup of coffee so that I can be indifferent between the two. And what I've just said that if pure expectation theory works, it will tell us that bonds with different maturities, like in this case, we had bonds or instruments maturing in 1 year, and then we also had a bond which matured in 2 years, right? At the end of it, we saw that no matter which strategy you followed, either you went with a series of 1 year bonds or you went with a 2 year bond straight away. Either way, your return would have been the same, 10.5%. So one is a cup of tea, one is a cup of coffee, and there's nothing to choose because the satisfaction derived from both cups is 10.5%. So we can say that bonds or financial instruments with different maturities are perfect substitutes of each other. That is another takeaway from the pure expectations theory. Ladies and gentlemen, any questions? Am I going too fast? Am I speaking Greek? Please tell me. Anyone?
I'm understanding.
Okay, Ariadne, thank you. How about you guys? Kyla, Majeev, Suresh?
So I think you're moving at a suitable pace.
Yeah, I'm so fast for good, sir.
Okay, all right. Okay, which is the next term structure theory, market segmentation theory. It's easy to follow. Pure expectations theory, one key takeaway was that bonds or financial instruments with different maturities can be perfect substitutes of each other. We saw that just now. Market segmentation theory is, well, if pure expectations theory is the North Pole, then market segmentation theory is the South Pole. They are diametrically opposite to each other. And I'm not asking you to follow this theory or that theory. I'm a storyteller. I'm just telling you what the theories say. I'm just the messenger here. You are free to make up your own mind about what happens really. What do you see out there in the market happening? So when you go out there in the market from tomorrow onwards, keep your eyes and ears open and see what usually happens. Market segmentation theory says that bonds or financial instruments of different maturities are not substitutes of each other at all. At all, at all. They don't see eye to eye. Short-term financial instruments have their own mechanism of determining their interest rates. Long-term instruments have their own mechanism of determining their interest rates. There is nothing common. They don't share anything at all with each other. They live in watertight compartments. Short-term debt instruments will have different prices and interest rates, and their long-term counterparts will have a totally different set of prices and interest rates, which simply means that the market for the short-term instruments and the long-term instruments will be completely segmented. There will be no integration. There will be no connection between the two, right? That is what is the market segmentation theory. Expectations from one segment of the market do not affect the expectations of the other segment in the market. That is what is market segmentation theory. It votes for independence of interest rate determination for short and long-term instruments. In the pure expectations theory, we see that there was a connection. The moment we said here, watch here, let me point out with black ink. The moment we wrote this part here, that long-term rate is an average of the short-term rate, there was an instant connection established between the two type of interest rates. Isn't that so? Because whatever happens to the short-term rates here will determine what will happen to the long-term rate here, right? Because it's basically the long-term rate is nothing but an average of the short-term rate. So both of these rates go hand in hand. They move pretty much in the same direction. Market segmentation theory, on the other hand, says that there is no such thing. Their interest rates are totally independent of each other. There's no substitution possible. So, Dr. B, whether you'll have a cup of tea or a cup of coffee, and if I will say that, obviously, anytime I come, don't even ask me the question, just offer me a cup of coffee, please. Tea is a total no-no. Then I've just indicated that tea and coffee don't see eye to eye. They are totally different in my point of view. No substitution possible. Then the third one is the liquidity premium theory. What does that say? It says it's based on investor psychology. I will just create a situation for you. You will tell me the theory yourself. You'll create the theory yourself in your mind. Folks, imagine if you were to close your eyes and just imagine me standing in front of you, and in my left hand, I was offering a financial instrument which was maturing in 5 years from now. And in my right hand, I was offering you a financial instrument which would mature in 25 years from now. Without thinking and without using any of your logical abilities, what does your gut feeling say to go with which one? My left hand, which contains a 5-year instrument, or my right hand, which contains a 25-year instrument? You don't have to think, instant response, gut feeling. Which one do you go to as an impulse first? Don't let logic pollute the gut feeling. Which one do you accept just based on an impulse? I'd like to hear from you. 5-year investment looks better, or a 25-year investment looks better to you? Without thinking much about it. No one want to say anything? Ajib, you're saying 25-year because, okay, you want to keep earning the interest for a long period of time. Okay, anyone else? Anyone else? No one wanting to pick my left hand with the 5-year instrument? No one? All right, so Majiv, what actually happens, or what researchers have observed in the market, is that there is a natural tendency for people to gravitate instinctively towards those financial instruments which do not take too long to mature. Remember, in the starting phase of our session tonight, we talked about liquidity preference. You would rather prefer to lend for a short period of time rather than lend for a longer period of time, because longer the time period, greater the uncertainty associated with it, right? So what people do usually is, let's just change color here. Generally speaking, short-term instruments are preferable. So we'll check it, because you can be more certain about what's going to happen in a shorter period of time as compared to what will happen in a longer period of time. In a long period of time, many variables, all variables are open to change. Who knows which government will be in power? Who knows what will be the geopolitics? Who knows what will be the foreign exchange value, foreign exchange availability? Who knows whether there will be democracy or dictatorship? Who knows what the interest rates will be like? Who knows where the inflation will be? Who knows whether we will be there or not? The degree of uncertainty about n number of variables is that much more greater if you increase the time horizon. Whereas in a shorter period of time, you still can have a reasonable handle on what's going to happen likely. You can project with a greater degree of certainty and feel a little bit more confident about the short term as compared to the long term. So that's why most people, when they want to invest, and when I say invest, I mean lend their money, they will want to invest for a shorter period of time so that they will recover their money in a reasonable amount of time, and then they can lend it out again if they so wish. Instead of just lending it out their set of money for the next 25, 30 years and just keep waiting 20 years to recover their principal. So not many people want to do that, instinctively speaking. But then if you start to bring in the logic, like Majib, you might have thought about logically that, okay, if I will go for a 25-year loan to somebody, let me lend my money to you for 25 years and then sit back and relax because I have created a long-term asset for myself. For the next 25 years, I don't have to worry because I will keep receiving interest income by just doing nothing, sit at home, relax, and the borrower just keeps making me interest payments. So I have locked in an interest rate for the next 25 years. Nice thing. So then you can start to have logical arguments and rationales, which are okay. But my question was that if you had to make a split second decision, what would that be? Most people, it has been observed, will go towards the short term. So if short term investing is what most people gravitate towards, then the demand I'm submitting here humbly is the demand for the short term instruments will go up. If the demand for such instruments will go up, then the price of these instruments will also go up. And now, something which I have not told you earlier, and it's important for you to remember for the purpose of this chapter, and anything that relates to borrowing, lending, or debt instrument, is that the price of a debt instrument and the rate of interest out there in the market, they have an inverse relationship with each other. Will you be able to remember this? This is an important thing to remember. The price of a debt instrument and the rate of interest have an inverse relationship with each other. So if the price rises, the rate of interest will fall. Right? So which means that the short-term investments will give us a low interest rate, and they will be available at a higher price because they are so much in demand. On the other hand, we have a long-term instrument. Nobody wants it. Very few people want it. Majid wants it, but no one else said anything. So relatively speaking, there's not much demand, or relatively speaking, the demand for the long-term guy falls. So the price falls. And because prices and interest rates have an inverse relationship, the rate of interest on such instruments will be high. Well, it's okay, we say that, but there's an intuition behind it. Just imagine yourself to be in this position. If you prefer to purchase a short-term investment for yourself, and if Dr. B is trying to convince you, no, Majid, forget about the 25-year, no, man, go for the one in my left hand, which matures in uh, or maybe you're preferring 5 years, and I'm trying to convince you go for the 25-year one. Then you say, okay, 25 years is too long a time. There are so many uncertainties involved. Maybe on a short-term investment, I'm already getting 4%. But if you just think about sweetening the deal a little bit, maybe I can consider a long-term. Because if I go for a long-term instrument, then note that the demand for that instrument is not too great. So if I have this instrument today, and if I want to sell it off to somebody else, a third party tomorrow, there will be hardly anyone wanting to buy it from me, and I will be stuck with this instrument. If I wanted to convert it into cash later on tomorrow, I will be in a fix, I will be in a problem. So as a compensation for that problem, what is this problem? Liquidity problem, not being able to sell your instrument. Why you're not able to sell the instrument? Because there's not so much demand for this instrument. So, Dr. B, if you're giving me this instrument, which suffers from a lack of demand actually, and consequently a lack of liquidity, then you'll have to sweeten the deal a little bit. Instead of 4%, maybe I'll accept 7% of this Do you understand this, folks? If the rate here is 4% and the rate demanded by you to be convinced to accept a long-term instrument is 7%, then the difference between the two is 3%. So plus this 3% is a compensation that you're asking for from Dr. B, so that this 3% compensates you for that lack of liquidity this instrument suffers. So therefore, this is liquidity premium. And that's what the liquidity premium theory is. It is that the investors will perceive short-term investments to be more liquid and therefore less risky as compared to their long-term counterparts. And the implication out of this is that anybody who's wanting to borrow, in other words, anybody who's wanting to sell these financial instruments, will have to offer a higher rate for long-term instruments so that they are able to entice or attract the investors from their natural preference for short-term securities. Folks, do you understand? Any questions? No questions. All right. All right, let's move on to the corporate bond part now, the second half of this chapter. Folks, I have pre-written some important features or characteristics of corporate bonds. I'll ask you to review these few sentences for a couple moments, and then we can proceed from there. First thing, a bond is a long-term debt instrument. Remember that? And what does it indicate? It indicates that a company which is issuing the bond has actually agreed to borrow a certain amount of money. And because they are borrowing, they will have to make a promise to repay it in the future. And this arrangement will have to be specified in very clear, defined terms. And these terms and conditions are known as, the formal word used for that is a bond indenture. Indenture is just another name for a contract. So I'm not discussing the details of a bond indenture, but there's material in your textbook to read about bond indenture. Please do go through that. The terms and conditions which are applicable in this kind of an agreement is they are specified in a bond indenture. Then every bond will carry a coupon interest rate. Please remember this. And this coupon interest rate is stated as a percentage, and it is a percentage of the bond's par value. Remember, par value has another name, face value. And this face value usually, unless otherwise stated in a question, is by default $1,000. If a question does not say or talk about face value or par value at all, you are supposed to assume it to be equal to $1,000. So a coupon interest rate is the percentage of bonds par value. So if we say coupon rate is 4% on a certain bond, it means that this bond will give us an interest which is equal to 4% of 1,000, 4% of the par value. And this is a per annum rate, 4% per annum. So that's what it says here, will be paid annually. But usually what happens is, though this is an annual payment, it is broken down into two parts, two equal semi-annual payments. And this is actually the interest payment. So basically what you understand from this is that whenever you invest your money in a bond, or in other words, when you purchase a bond, you will get interest payment because you have actually lent out your money to the company or the government if it's a government bond. And the interest amount in dollars will be calculated as the coupon rate multiplied by the face value. Coupon interest rate is the rate applicable for this particular bond, whichever bond we are talking about. Not two interest rates. I'll change in and write those two interest rates for you. One we have just come across, coupon rate. Coupon rate. This is specific to a bond. Bond A may have a 4% coupon interest rate. Bond B may have a 7% coupon rate. Bond C may have a 3.5% coupon rate. It's bond specific. And the purpose of this is only to calculate the coupon dollar amount. How much amount are we getting? Coupon amount. How much amount are we getting in the form of interest from the bond? It's known as coupon amount, right? The purpose of the coupon rate is to calculate only that. Once you've done that in a certain question, you will forget about this. You will throw the coupon rate away. The second important interest rate that you must be aware of is the market rate. Market rate, maybe, folks, is not specific to the particular bond that we may be considering. It's the general interest rate out there in the market. It may be greater than coupon rate, it may be less than the coupon rate, or it may be equal to the coupon rate. It can keep on fluctuating. General interest rate. So that's another point of distinction. Coupon rate will remain fixed for the bond because it's specific to a bond. Unless, of course, the bond is a variable rate bond. We are not going there in this course. We will stick to fixed rate bonds, for which the coupon rate will remain fixed, static, unchanging throughout the term or the life of the bond. But the market rate is the general interest rate out there in the market. It can fluctuate. The government may announce a drop in interest rates. They may announce a rise in the interest rate. The inflation may go up or go down, and that may affect the market rate. The risk complexions may change in the market. All the factors that we had seen earlier that affect the interest rate that are at play in the marketplace and will have an impact. And this can fluctuate up, down, up, down, up, down. Coupon rate remains fixed, flat throughout the term of the bond. So in the problems that we will solve, the numerical problems, anytime you need to discount something, anytime you need to discount something, you will always use, ladies and gentlemen, hear carefully, please, always use the market rate for discounting. Never use the coupon rate for discounting purposes. Coupon rate has only one function: to calculate what dollar amount of interest will be earned on this bond on a periodic basis. That is all. Right? So next, the bond's par value or face value is actually representing the amount borrowed by the company. And it is written on the face of the bond. When they will give you a bond certificate, this $1,000 or whatever is the face value of the bond is going to be printed on the bond certificate, acknowledging the fact that this is the money that we have borrowed from you, right? And this is the money which is back due to the lender on the maturity date, where the maturity date is the time at which the bond becomes due and the principal must be repaid, right? Folks, any questions about the corporate bond? Anything that is not clear, or anything that you would like me to repeat? No questions. All right, so let's move straight into bond valuation or bond pricing, folks. It's going to be easy if you have found some time to use the financial calculator, and if you have found some time to look at the time value of money problems. And by the way, I had uploaded those documents on the course page announcements forum. I hope everyone has retrieved those documents, the time value of money documents. If you were able to spend some time and use the calculator or the tables or the formula, whatever, then you will find that computing the price of the bond is child's play. It's very, very simple because you need to perform only two operations. One is to calculate the present value of all the future coupon payments, and then find out the present value of the face value of the bond. Once these two are determined, just add them up, and that will become the price of the bond. That's all. So if you want to have a visual of how a bond lives its life cycle, let's imagine in the interest of time and space, let's just imagine a 5-year bond, maybe. Right. So here's the timeline: time 0, time 1, time 2, time 3, time 4, time 5. So we want to figure out the price of this bond today. In your textbook, I think it has been denoted as B for bond. And in the subscript, they say 0 because 0 is the current period of time and you want to find out the current price of the bond. That's why B0. So if you stand here on the timeline and you look ahead into the future, what do you realize? You realize, let us say that this is let's just write it formally. This is a, just make up something, 8% 5-year bond. 8% 5-year bond simply tells you that this bond has a coupon rate of 8%, which means, well, if the face value is $1,000, then the coupon amount, which is basically the interest that you're receiving, coupon interest is 8% of 1,000, that's $80, right? So what will happen is, at the end of the first year, you will receive $80. We are assuming that interest payment is made to you only one time in a year, for now, for the sake of simplicity. At the end of the second year, you will receive another interest payment, $80. At the end of the third year, you will receive another payment, $80. At the end of the fourth year, you receive another interest payment of $80. In the fifth year, the bond matures. It gives you two payments. One is $80 interest, and then it gives you back the original amount that you had given the company, the face value, $1,000. So in the fifth year, you get 1080. But because all of these things you're receiving in the future, you will need to discount them back to the present moment. So you need to take this 1 period back. You need to take this 2 periods back. You need to take this 3 periods back. Take this 4 periods back by discounting them. Take this 5 periods back. How do you do that? Well, you will find out the present value of the future coupon payments, which is this. All these future coupon payments. You will find out the present value of the face value, which is this. So once you get the present value of this thing, this stream, which you will recognize, this is just an annuity, same payment repeated again and again at the same interval of time. So you will find the present value of the annuity here. And this is just one single amount, lump sum. You will find this present value. Once both present values are calculated, you will add them up. This will become P0. Ladies and gentlemen, any questions about the procedure of how to calculate the price of the bond? Any questions, folks? Or can we go into a problem straight away? Because next up, I'm seeing a question is popping out where we have to compute the value or price of the bond. Any clarification needed before we go into this? Or should we jump into computing the price of this bond? No questions. All right. So tell me then again, should I do it using the manual process or just go to the calculator? I think John will want me to use the manual process as well. So manually, if you want to do it, I mean, you can just visualize it first as a timeline. This is what 20 years, right? So these are your time periods starting at 0, 1, 2, 3, 4, 5, on and on and on, 20 periods. Well, they have been kind enough to mention that the bond has a face value. They write this M to indicate that face value is the maturity value also, because this is what you get at the time of maturity, $1,000. Time to maturity is 20 years, so that's why we plotted a 20-year timeline. Coupon rate is 10%, so which means the coupon amount in dollars is 10% of 1,000, that's $100. And then the current market rate, also known as the required return. I'm just calling it K. I think in your textbook, this is referred to as R with a subscript of D, RD. So call it A, B, C, D, R, whatever. As long as you know what it is talking about, you're good. So that is 8%, and this will be the rate which will be used for discounting purposes. Remember, we have to calculate the present value, so we will need a discount rate. This market rate or required return, call it whatever you like, will be the discount. This will be the rate of discount, and that's 8% here. So in a timeline, how does this bond look like? We want to know how much should I pay for this today if I'm buying it from the market? What should be the price of this bond, the value of this bond? So I notice that at the end of one period, I'm going to get 100, another 100 interest payments, another 100, 100, and so on, so on, so on. In the last year, I'll get 100, and I will also get 1,000 back, right? So this stream, this cash flow stream, this part is an annuity. Yes. So I can say if I give it a notation, this is interest payment. So let me just use the letter I for interest. So B0 is equal to I, and I want to find its present value. This is an annuity. So I will multiply this by, if you're using tables, then present value, interest factor of the annuity for what percent? What is my discount rate? 8%. For how long? 20 periods. 20 periods. Right, so this is one component. What is the second component? The second component is this one single item. So since this is one single item, so let's just, because we are just writing a formula type thing, so let's just not write the value at the moment. Let's just write to, call it M or call it face value, whatever you like. And because we want to find its present value, so this 1,000 we will receive after 20 years. So in present value terms, what it is worth. So multiplied by present value interest factor of $1, because this is not an annuity, and 8% for 20 periods in this case. So we can just substitute the numbers, 100, and we can multiply with the factor. You can look it up in the table, or you can calculate it as like this. So this is the present value interest factor of the annuity. You can calculate it like this, or look up in the table, or simplest is to use the financial calculator though. Face value $1,000 and multiplied by the present value interest factor of $1, which is this. And just add the two guys up. That's the price of the bond. Would you like to do it yourself for practice, or should I just give you the result? What do you want to do? Guys, are you there, or you have just walked away from your computer? Nobody's saying anything at all. Am I just speaking in a vacuum, or okay, Samantha, you say I should go ahead and give you the value. Okay, so if you calculate it, the first term here will give you 981.81, and the second term will give you 214.5, and so that the price of the bond will be a sum total of both, and that is 1,196.31. Yes, John, that is correct. If you want to do the same thing on the financial calculator, we can, first of all, let's just list the inputs, financial calculator method. And we will just provide these inputs to the calculator and quickly get the result. So we know, what do we know? We know that after 20 years, that is a future point in time, we will get this money. We also know that we will get this money after 20 years. We know that the discount rate is 8%. We know that during all of these 20 years, we will receive a constant payment, interest payment of $100, because 10% is the coupon rate, right? So, and then we will say, after we have provided these inputs, we will just say compute CPT, present value, because it's the present price that we want to determine. So let's just implement this on the calculator. Is my calculator visible to you? Okay. So just like I told you last time, the first thing that you should do, always make it a habit. Second function, clear TVM, so that all previous memories are erased. Now, what are our inputs? We have said 1,000, 1000 is what I will get at a future point in time after 20 years. So since I just said 20 years, so 20 is my N, and my discount rate is 8%. So I press 8 and then store it as I over Y. And I also know that during this whole time, I will every year keep on receiving $100 interest payment. So I store it as payment. And then I say compute CPT, present value. So that gives me 1196.3629. The negative sign is just indicating that I'm paying this money to buy the bond, the money leaving my pocket. And what is incoming? A bond certificate. So that's how quick it would be to use a calculator. Right? Everyone who was using the calculator is comfortable with this? Did you all obtain this result on your own devices? Okay, great. Right. Let's clear the display. And as a habit, look what I'm doing. I'm just pressing second function and clear TVM, so that the next time I come, I find a clean calculator. So, right, so we are back here. And let's see what we have next. Question number 2. Let's read it, and I will tell you a couple of things which you will need to keep in mind. Compute the price of a 10% semi-annual. So this needs to be paid attention to. Semi-annual coupon bond. John, this time around, I will not do the manual stuff because now you know what is to be done. We have done it once. So we'll just straight away go to the calculator. So compute the price of a 10% semi-annual coupon bond with 12 years left to maturity when the current market interest rate is 8%. What we will do is, first of all, observe a couple of things. We'll have to deal with this semi-annual coupon. It's telling you that though in a year you will be getting the 10% interest, but it's going to be broken into two installments. The first 5% you will get after 6 months, the next 5% you will get after the next 6 month slot. So basically, then we are breaking the year down into two periods, right? So my question to you is, during these 12 years, how many 6 month periods do you see? Samantha, how six? 1 year has two 6 months periods.
It's
So
24.
how many? 24 such periods, yes. Everybody is okay with this, Samantha? 1 year has two periods. 2 years will have four periods. 3 years will have six periods, right? Yes. So one thing we know, let's write down our conclusion here first up. We will have 24 periods to deal with. And when we are calculating payment, the interest amount, what will we do? We are supposed to get 10% in 1 year, but every semi-annual, every 6 months, how much will we get? We will get only 5%, right? So every 6 months, we get 5% of the face value. So that's $50. We know at the end of 20 years, we will get $1,000. We also know that we have to use a discount rate, which is actually 8% on an annual basis. But because we are using 6 month periods, so the rate, just like the coupon rate was divided by 2, the discount rate or the market rate will also be divided by 2. So 8/2 is equal to 4%, right? And now we can just ask the calculator what the price be. What will the price be? Can you calculate on your calculator and tell me what the price is instead of my showing it to you? Because you know what is to be done. It's just simply pressing some keys. Store these variables into the places where they belong and then compute present value. Share your answer in the chat box or through the mic, please. Meanwhile, for John, Suresh, you're saying 1152.47. Samantha also. So, all right. So we agree with that. $1,152.47 is what will be paid for this bond if you want to buy it today. Okay. Folks, at some point in time during this session, we said, I'm going to change color to make a point here. We said that the price of a debt instrument, in this case now our debt instrument is this bond. So the price of the bond being a debt instrument, and the market's rate of interest. Well, how do we write it? Should we write K or should we write RD? I don't know. They're inversely related. So which means that if the interest rate in the market goes up, the bond prices will likely fall, and the opposite is true as well. So now there are three results I'm going to tell you, which will help you actually in knowing whether you are on the right path when you're making your bond pricing computations. If your coupon rate is equal to the market rate, which is, well, RD, then the price of the bond, B0, is equal to the face value of the bond. So in this case, don't start using your calculators and don't start using your formulae and all of that, because you know by default the face value is $1,000. And if you notice in a question that the market interest rate and the coupon rate are same, like in this question, you can verify on the calculator. So instead of 10% here, instead of 8% here at this point, if you use 10%, what will happen? This will become 10 over 2, and this will become 5. Can you run the calculation quickly? Without running the calculation, I can say that since the face value is 1,000, the price of the bond will also be 1,000 here. So there's no need to calculate here, but you can verify on the calculator very quickly that if you recompute with the change that I've made here, that this thing will change to 1,000. Yes, so this is a very quick way of knowing. So the first thing that you should be doing actually when you are dealing with a question like this is to quickly look at the coupon rate and the discount rate or the market rate. Compare the two. If they're equal, don't calculate the price of the bond. Just say it's equal to the face value and is equal to $1,000. Second, if the coupon rate is greater than the market rate, then the price of the bond will be greater than its face value. Did you observe that in the question that you just solved? Coupon rate here is 10%. Market rate here 8%. Coupon rate 10% is greater than the market rate of 8%. So therefore, the price of the bond must be greater than the face value. The price of the bond calculated was 1152.47, which is greater than the face value. Yes, everybody's with me on that. So once you compare these two rates, the coupon rate and the market rate, or the discount rate, whatever you choose to call it, if you compare these two rates and you find that the coupon rate is the one which is higher, then you know at the outset without calculating that when you calculate the answer, it must be greater than 1,000. So in the event your calculation says that the answer is now less than 1,000, then you should know immediately that there's a mistake. Because under no circumstances it will be less than 1,000 or equal to 1,000. It must be greater than 1,000 if the coupon rate is greater than the market rate. Third is obvious. The coupon rate, if that were to be less than the market rate, then the price of the bond will be below 1,000, less than the face value. So to begin with, just compare these two rates, and if the coupon rate happens to be less, then you know before calculating that your bond price will be less than $1,000. If it is anything else, then there is a mistake somewhere. Good. Can we proceed? Great. Let's talk a little bit about bond yield now. There are two types of yields we will talk about in the live session, but there's a third one as well. You can read about that in the chapter material. Because once you deal with these two, the third one will be just an extension. There's nothing new in there in that one, just a variation. The first one you are seeing on your display is the current yield. And as it says there, it measures the annual return to an investor. And the basis of computation of this return is the current price. That's why the name current yield. And to calculate it is easy. Current yield is equal to, you just calculate the annual coupon interest and divide that by the current bond price. You just see an example below that. What is the current yield for a 10% coupon bond currently selling for 1150? What would you do? 10% coupon bond means 10% coupon rate applied to a face value of 1,000. will give you a coupon amount, a coupon interest payment of $100. So current yield is $100 divided by the current price of the bond, 1150. That's all there is to it. If you run this calculation, it should give you around 8.7% approximately. That's the current yield of the bond, as straightforward as that. The second thing is the yield to maturity, which the concept, we talked about it earlier, and we said that it's repeated here. It measures the compound, because why we use the word compound? Because we are using TVM, time value of money. So there's compounding going on, one period after the other. And this is on a compounded basis. It's the annual return to an investor. You will earn this return if you buy the bond today and then you hold on to it till the date of maturity. Don't sell it off before the maturity date. Hold on to it till maturity. If you do that, then the return that you would have earned on an annual basis will be known as yield till maturity, right? For persons like John who haven't yet gotten a calculator, John, you can use this approximation formula to calculate the yield, the YTM of a bond. Otherwise, the easiest way to calculate the YTM of a bond is to use a financial calculator. We can do it both ways by looking at some data. Right. So this is let's just see if the formula will remain on display. And then this is the question. If I zoom out a little bit. Yeah. Right, so the manual part we will do here. So if we want to find the YTM of this bond, we can say this. The interest, which is the I for interest, this is interest. This is face value, F. This is price of the bond, face value of the bond, price of the bond, right? So we can just use the data. In this case, coupon rate is 9%. So which means that the coupon amount is 9% of 1,000, that is $90. Right. We need the face value. This is $1,000. We need the price of the bond, which is $820. Right. And we need to compute the YTM. Let's just plug in the numbers and see how the formula looks, and then your calculator can do the rest. I, interest amount that we get, plus the face value is 1,000 minus the price of the bond is 820 divided by the number of years are here, 8, and then divide by 1,000, which is the face value, plus the price, which is 820. You take an average of that. So if you calculate this, you'll get an approximation. This will not be the true YTM. It's an approximation of the YTM. It will be 12.36% here. So if you're using this, it will be a good idea to write approx. Right, so simple enough. But if you're using the calculator, financial calculator, then the task is faster, easier, more accurate. What do we know? We know this. This in time value terms translates to face value is 1,000. We know this. This converts into, this gives us a coupon amount of $90, which is our payment. We know this. This is N. We know this. This is present value, current market price. Folks, don't enter these values into your calculator yet. I will tell you first what to do. And then YTM is what is supposed to be computed. So we will say at the end, compute interest per year. You must realize, you must first take a stance and it's easier always to take the stance of an investor who will purchase the bond today. Since that investor will purchase the bond today, the price of the bond will leave his or her pocket. So negative, this should go in as a negative number, price, the present value. But then after having paid this 820, they will continue to receive positive payments of $90. And then at the end of the 8-year period, they will receive a positive payment of $1,000. So either do this, or if you want to assume the stance of the seller of the bond, you will say this, you will be thinking this, that after 20 years, I will have to pay back 1,000. During the 20 years, I will have to continuously make a payment of $90 every year. And today I am getting $820. Somebody is paying me that. Compute this for the buyer. This is YTM, the yield or the return. For the borrower, this is cost of borrowing. The same number will be seen differently by different people. So either put this into your calculator or put this into your calculator. Your result will be the same. Check, please. And announce the answer on the chat box or through the mic. $12.71. Okay, Samantha. Anyone else confirming this, please? Why I seem to have a different result. Let me check. 1,000 gone into face value, future value. 8 gone into N. 90 gone into payment. 820 negative gone into present value. And then I'm saying compute my interest per year. Yes, Samantha, you're right. John, Suresh, correct. 12.7144% approximately. Right. For some reason, when I did it before, it gave me 12.53. I don't know why. So anyway, 12.71% then is the YTM. It tells you that if you buy this bond today and hold on to it till the date it matures for the next 8 years, that is, in those 8 years taken together, you would have earned a return of 12.71% on a per year basis, per annum. Okay. Moving ahead, we'll just finish this off. There are 5 questions. We have reached number 4. Now, this is a situation again where you'll have to pay attention, please, because this time the coupon rate is being compounded on a semi-annual basis. Semi-annual basis. Semi-annual basis means that whenever it's a semi-annual thing, now remember, double the time. And half the rates. Folks, just so I know that you have been following this, if instead of semi-annually, this thing said compounded quarterly, then what would you do? If it was quarterly, then what would you do?
4 times the time and quarterly rate.
That's so correct.
Yeah.
So we would then say time times 4 and rates, whatever the rate is, divided by 4. Okay, so let's tackle this. Let's just use the calculator inputs for this. We have the bond price. This is your present value, because I'm assuming the stance of somebody who's buying the bond. So this money leaves me today. So goes into my calculator as a negative item. Coupon rate is 9.2% compounded annually. So my payment is 9.2 divided by 2% of 1,000, which is what 9.2 is 4.6% of 1,000, $46. So payment is 46 plus. And then what we have, so this one is dealt with. Next item, time to maturity and semi-annual. So 10 into 2, 20 semi-annual periods in 10 years. What is YTM? Calculator results, please, folks. I hope you didn't forget clear time value of money before you started this. Anybody can please announce the result here? Otherwise, I will have to do it on my calculator. Suresh, Samantha, 4.298. Okay. Confirmation, please. Suresh, what did you get? John? Anyone else? Okay, Samantha.
I get in a negative 1.1.
Yeah, same here. Again, a negative. So I want again a negative one.
Strange.
Yeah,
Strange.
11403. Yeah.
Strange. Let's check. So this is my previous working. I'm going to clear it off, and then I'm going to second function clear TVM. What are my inputs? 1,000 going into the future value. Then do I have a price of this bond? What was the price, boy? 1,040. Thank you. 1,040 is the price which I pay today. So that is going in as negative, minus 1,040 as present value. Then payment we had calculated $46 we will receive interest. So 46 goes into payment. And this happens for 20 semi-annual periods. 20 goes into N. And then I say compute. Give me a sec. Compute interest per year. So that gives me 4.2979 or 4.298, which Samantha had reported. Is it okay with everyone? Did you locate any mistake that you might have? Okay.
Yes, sir, I got it.
Okay.
Enter one of the values.
Okay. Okay. So this was 4.2979, so 4.298%. But the question doesn't stop here, though. We are supposed to calculate the YTM. So let's just change color here. YTM. As long as the compounding was annual, we could calculate interest per year, and whatever was the interest per year would be the YTM. But we have to take this time one extra step because the compounding is being done semi-annually. And what did we do? We doubled the time, but we halved the rates. And these were the inputs that went into the calculation. So this also is a half yearly rate. This is per 6 months. And YTM is always expressed as an annualized figure, annual figure. So YTM will be, now it's time to multiply it back and make it annual. 2 times 2 semi-annual periods. So on a yearly basis, this will be, so it's 4.3, so approximately 8.6%, I guess. So when you're solving a question like this, just be mindful that don't stop at compute interest per year, just go one extra step to state your YTM as an annual figure. Yes, Samantha, 8.596. Great. Okay, one last question before we close for tonight. How about you do this as practice? I will hold on for your results. I will tell you what I found out for this. See if you can get the same answer. The question asks for what's the coupon rate this bond offers. When I calculated, it gave me approximately 6.08%. So on the calculator, it doesn't say annual or semi-annual. So let's just do the easy part. Assume it to be annual. Only one out of the 5 time value variables is left. Can you give me the readout of from your calculator? What's the payment? Right, yes. So that's what I got as well, 60.78. So this tells me that in the form of interest, every year I'm getting $60.78, but this $60.78 is supposed to be some coupon rate X% of the face value. So you know where this is going. So what's this X% then? So that's it. Yes. Right, so that is it. Folks, apart from this, there are some other sections, as I mentioned, that you should read about in the chapter. Most computations in this chapters are approximately similar to what I've done with you tonight as demonstrations. Some things you should practice on your own because there is no substitute for self-study in practice. So please be mindful of that. Some other things that you can read about is like, for example, I mentioned earlier, bond indenture, which is basically a contract between the borrower and the lender, which specifies the rights of the lender and the duties and responsibilities of the borrower. And one specific part of this bond contract or bond indenture is known as restrictive covenants. Read about that. The general idea is that restrictive covenants, just the word restrictive tells you that anytime a lender would lend their money to somebody, they would want to make sure that their money remains safe. So they will not want the borrower to do some activities which they deem risky. So they will say, don't do this, don't do this, don't borrow more money until you repay our money. Don't give dividends to your shareholders till you pay back our money. Don't invest in this particular risky project till you pay back our money. Like that, all restrictions that are placed are restrictive covenants. So read about that. Take you 5 minutes to do it. Then there are some type of bonds known as different type of bonds. What we discussed today are called bullet bonds, though it's not mentioned in your textbook. Bullet bond or a straight bond. But other type of bonds which are covered in your textbook are, one of them is a callable bond. Like for example, in the previous example, we had 16 years for the bond to mature here. But if the company says, okay, we are going to return you the money that we borrowed from you before time, so we are not going to hold on to the loan for 16 years. We'll return you your money before, let's say after 8 years, we will say that the company will call the bond back after 10 years. So what are the reasons why the company might decide to call the bond back before time and return your money to you before time? You can read about that. What are the factors which influence that decision? Then there are some bonds we will come across which are known as bonds with a sinking fund feature. Sinking fund will simply, because usually when we look at the term fund, we know that this is something we keep depositing into a fund and the value of the fund keeps growing over time. But this one is opposite, as it says itself. The word here tells you sinking fund. The balance in the fund, the balance in the fund keeps declining over time. So basically, this is a fund, right? The balance keeps declining. Why is it declining? Is that maybe let's say every 2 years, withdraw from this and repay a part of the bond. So if you had borrowed $1,000, repay $100 worth of principal after 2 years. Then after the next 3 years, again withdraw from here, repay $100 more worth of principal. After 3-4 more years, take money out of this fund, repay another $100 of the face value. So that this is basically what you're doing here is you are retiring the bond on a periodic basis. It's called periodic retirement of the bond. Sometimes the lenders insist that we don't want to wait these 16 years to receive this $1,000 back. We want it to be paid back to us intermittently on a periodic basis. So if that is the arrangement that is done in the bond indenture, then the company will set up a sinking fund where they will keep some money aside into this fund and then use it to keep repaying on an intermittent basis this sum of 1,000 values over time, dollars over time. So that's a bond with a sinking fund feature. So some such things are there in this chapter for you to read up on. It should take you about 15 minutes to half an hour to read up on those things. And then at the end of the chapter, there are problems for you to practice. Try as many of them as possible, please. If there are no further questions, then we will then close for tonight. And the next time we meet, we will pick up stock valuation, which is your next topic. Also, when we meet next time, you should have arrived at a consensus about the date of the coursework exam. Please so inform me so that we are all on the same page. Right? Any questions before we close? No questions coming through. So, all right, then, ladies and gentlemen. Yes, somebody was saying something.
No, I said still no questions and thanks.
Okay. All right, then, folks. Then have a very good night, everyone. Stay safe and stay happy. Stay blessed. Bye-bye.
Bye.
Bye, guys.